We have already discussed in the previous lessons the price terms on which debentures are issued, that is at par or at a discount or at a premium. In this lesson, likewise, we shall discuss the price, or rather the price terms at which the debentures are to be redeemed. It would then also be useful to make a distinction between the terms attached to the issue price of debentures and the terms attached to its redemption price. Terms such as at par, at discount, and at premium. We already have seen previously that depending on the terms attached to the issue price, the debentures may be issued at par or at discount or at a premium. We have dealt with these possible scenarios in the previous lessons. We are thus familiar with the associated entries. We are now being introduced to a combination of terms that a debenture may have. Terms attached to the issue price of debentures and terms attached to its redemption price. Now, redemption simply means paying back of debenture amounts to debenture holders after maturity. When the amount payable at the time of redemption is equal to its nominal or face value, the debentures are said to be redeemed at par. In the normal course, redemption price would be at par if the terms of redemption are not mentioned while issuing debentures. There is no gain, there is no loss. There is no additional entry, and hence the entries remain the same as if only the terms attached to the issue price are considered. We are still in familiar territory. When, however, the debentures are redeemed or paid back at a price above the face value, the excess amount is called as a premium on redemption. This is a capital loss. This has to be recorded and calls for an additional entry. This problem does not deal with the redemption of debentures at a discount. This is because redemption of debentures at discount is rather unusual and practically non-existent. This leaves us only with redemption options of at par or redemption at a premium. All possible combinations of terms are dealt with in this problem. As indicated previously, the redemption at par is treated the same way as issue of debentures without redemption terms. The first three combinations, that is A, B, and C, describe scenarios that involve redemption at par. So, we have to deal only with its combination, that is, the terms attached to the issue price of debentures, such as at par, at discount, or at a premium, which we have already covered in the previous lessons. As mentioned earlier, we are already familiar with the treatment of these scenarios. Now let's start at the very first option. The debentures are issued at par and redeemed at par. There is no gain or loss either at the issue or at the time when the company is to redeem the debentures, and so there is no extra entry. These are simple, straightforward entries. 1. To record the receipt of money. Bank is debited with the amount of cash received. The corresponding credit goes to the temporary debenture application account. Thereafter, it is promptly transferred to the debentures account, where it ultimately must be posted by debiting the debenture application account. In the process, the debenture application account is closed. Next, we look at debentures issued at discount but redeemable at par. The first entry, as usual, is the debit to the bank to record the receipt of debenture application money into the bank. Credit going to the debenture application account. The second entry that records the transfer to the debentures account will have to account for the shortfall in receipt of money while transferring the full face value of the debentures issued. That is, the full face value is credited to the debenture account to reflect the real liability of the company. That is, the company owes the debenture holders the full face value of the debentures, though it has received something less from the debenture holder, as per the terms of the issue of the debenture. This is a capital loss and is accounted as discount on issue of debentures. Next, we shall look at the case where the debenture is issued at a premium but redeemable at par. The first entry, as usual, is the debit to the bank to record the receipt of debenture application money into the bank. The corresponding credit going to the debenture application account. The second entry that records the transfer to the debenture account has to deal with the money received in excess of the face value of the debentures being transferred to that account. That is, the liability of the company is limited to the face value of the debentures issued. The money received in excess of the face value of the debentures issued is the premium demanded as per the terms of the issue of debentures. This is a capital profit earned by the company at the time of the issue of the debentures and has to be accounted as securities premium reserve account. With the completion of the transfer to the debenture account, the debenture application account is closed.
Thus far, we have dealt with combinations involving redemption at par. To summarize, we have seen capital loss and capital gain resulting in the context of the terms of issue price of the debentures. That is, when debentures are issued at a discount, there is capital loss, which is then accounted as discount on issue of debentures. And when there is a capital gain, the securities premium reserve account is credited. All this results from the terms attached to the issue price of the debentures. It is to be emphasized that there is no loss or gain at redemption, the redemption being at par. Now we move on to combinations involving redemption at a premium. Debentures which are to be redeemed for a price which is more than its par value or nominal value is known as debentures redeemed at premium. The difference between the par value or the face value and the price at which it is redeemed is capital loss. This is a future loss that will happen only at the time of the redemption that occurs at a later date, sometime in the future, after the issue of debentures and after maturity as per the terms of redemption. In this problem, we are not asked to record entries that are to be made at the time of redemption. Yet, in accordance with the prudence principle of accounting, whereby anticipated losses and expenses are provided for, entries will be passed to record the capital loss at the time of the issue of the debentures itself. Accordingly, the loss on issue of debentures account is debited,
while crediting the premium on redemption account,
which is a liability account that will be carried forward in the balance sheet till the debentures are redeemed. Now, these debentures that are redeemed at a premium could have been issued at par or at discount or at a premium. In the instant case, the debentures are issued at par and redeemed at premium. The first entry simply records the receipt of cash into the bank while crediting the debenture application account as usual. Now, the second entry to record the transfer to the debenture account. Having been issued at par, there would be no extra entry on account of issue. It would be a simple transfer from the debenture application account to the debenture account. However, redemption is at a premium. That is, debentures are to be redeemed for a price which is more than its par value or nominal value. This extra amount to be paid is a capital loss on account of premium on redemption. As mentioned previously, the capital loss, even though it is incurred at the time of redemption, that is, in the future, is provided for at the time of the issue itself. We understand that this is in accordance with the prudency principle, where all anticipated losses and expenses are provided for. The entry to make this provision is to debit the loss on issue of debentures account and credit the premium on redemption of debentures account. Thus we see that there is an extra entry complete with separate debit and separate credit. This is passed to record the effect of the extra amount to be paid at the time of redemption of debentures. The loss will eventually be written off to the profit and loss account. The premium on redemption of debenture account is a liability of the company to the debenture holders. This is carried forward in the balance sheet. This account also will likewise be wiped off with the redemption of debentures. Of this we shall soon see. Now, in this next problem, debentures are issued at a discount and redeemed at a premium. As usual, the first entry simply records the receipt of cash into the bank while crediting the debenture application account. But the amount is lesser than the face value of the debentures. This is because of the fact that the issue of debentures was at a discount. This will affect the second entry that transfers the balance in the debenture application account to the debenture account. The debenture account will have to be credited with the full face value of the debentures issued. The money is credited to the debenture application account, however, is something less. The difference is accounted in the discount on issue of debentures account. The extra entry to record the capital loss on account of redemption of debentures will have to be passed in this case also. Loss on issue of debentures debit, premium on redemption of debentures credit. Last combination in this scenario involves issue of debentures at a premium and redemption also at a premium. At the outset, we must realize that the issue of debentures at a premium results in a capital profit, whereas premium on redemption of debentures would mean that the company will suffer a future loss at the time of redemption or payback. The first entry will be the same: bank account debit, debenture application account credit. Only the amount will be more than the face value of the debentures. This is because the debentures were issued at a premium. This more amount or excess is a capital profit that does not have to be paid back on redemption as per the terms of the issue of debentures. Only the full face value of the debentures need to be paid back, and only this amount is credited to the debentures account. The capital profit is then credited to a specific account designated for this purpose: the securities premium reserve account. We are done with the terms of issue price. We still have to deal with the terms of redemption price. As per the terms of the redemption price, we have to pay back something more than the face value of the debentures. This is a future capital loss to the company. The company will have to bear this at the time of redemption or payback of debentures. This liability is not reflected in the debenture account but in a separate premium on redemption of debentures account. The extra entry therefore, loss on issue of debentures account debit, premium on redemption of debentures account credit.